Oscillators are a group of technical indicators that attempt to indicate the strength of a trend and if a market is overbought or oversold. It is called an oscillator because it moves within an upper and lower boundary. No matter how far the market moves, up or down, the indicator will never move above or below its set range. Common oscillators indicators include the MACD, RSI, and Stochastic, but there are other variations available. The Moving Average Convergence-Divergence indicator, more commonly known as MACD, is an indicator that attempts to gauge the strength of a trend. Traders use the indicator to determine when a trend is starting and ending and the best time to enter the trend. The indicator has three parts. The MACD line, which is calculated by subtracting a long moving average from a short moving average, typically subtracting the 26 exponential moving average from the 12-period exponential moving average, the signal line, which is usually a 9-period exponential moving average, and the zero line. Signals are generated when the MACD line crosses the signal line. If the MACD moves below the signal line, this is generally an indication of a down move, and if the MACD moves above the signal line, it is typically seen as an indication of a potential up move. Another signal is if the MACD line is above or below the zero line. If the line is above zero, the traders will generally say the market is overbought and may move down. And if the indicator is below the zero line, then traders will generally say that the market is oversold and may move back upwards. Another signal that traders look for is a divergence from price. The MACD line should move up and down with the trend of price. If the MACD starts to diverge from price, it might indicate a change in the trend of price. This chart of the E-minis shows that price slowly moved up as the MACD line moved lower, creating a divergence between price and the MACD line. Another oscillator is the Relative Strength Index, or RSI. The RSI compares the average size of the up moves over a period with the average size of the down moves over that same period. If the RSI is over 70, this is generally seen as overbought, and price might move down. A reading of 30 indicates a market that is oversold and the price might move up. Stochastics is another indicator that is used to gauge the trend of a market. The Stochastics indicator compares the recent close of a product to the range of opening and closing prices over a previous period. The basis of the assumption is that markets that are in an uptrend will close near the high of their range, and products that are in a downtrend will close near the bottom of their range. Entry signals are created by the two lines on the indicator, called the K and D lines. Typically, a reading over 80 is considered to be overbought, and a reading below 20 is considered to be oversold. Oscillators use price history to gauge the strength of the trend and if the trend will continue in the near term or may be getting close to reversing. Oscillators might indicate oversold or overbought for a long time, creating a situation where the indicator is signaling a reversal, but the market continues to move up or down in its original trend. Oscillators can be used in conjunction with other tools to inform your decisions about trades. As with all indicators, they can be combined with other tools or used on their own to form your analysis.